Hi students, how are you? We are starting with revision lectures to give you a glimpse of the whole chapters so that at the time of your exams, you just go through these points and that's enough. Enough to cover the whole chapter, saving lot of your time and energy at crucial point of time just before exams. CA Inter. I'm starting with advanced accounts. That is in group 2, paper 5, 100-mark paper. Question number 1 is compulsory. And out of other 5, you to opt any 4. That's known to you, nothing new for you. And today, I'm starting with revision of the most vital and most important chapter, Banking Company Final Account. Vital in the sense, every paper has it. Every paper, I mean. There's no exception to it. Right from the time the banking company is there in the syllabus, since years, not a single question paper has gone by which doesn't have minimum question of 6 marks of banking company till maximum 16 to 20 marks. Not a single paper. So that makes you understand how important it is. Advanced accounts, banking company final account. And why so, students? Because the term banking company final account, the chapter, covers much more subtopics, small subtopics like revenue recognition is there, like you have accounting for rebate on bills discounted, then accounting for calculation of provision for loss, you can call this as RDD, then accounting for acceptance, endorsement and other obligation, accounting for bills for collection, accounting for capital adequacy ratio. Then you also have how do you prepare a P&L account, how do you prepare a balance sheet. A question was asked, classification of non-performing asset. That we'll see in glimpse. A question was asked how to calculate CRR. And a question was asked on security-wise classification of loans and advances. So many subtopics, and hence every year one or two subtopic is always found. Okay, fine. We continue. What is a bank? Banks in India. I'm talking about commercial banks. All commercial banks in India, they are governed by guidelines of RBI. There is Banking Regulation Act of 1949 and guidelines of Basel Committee. So all this governs functioning of commercial banks in India. What is the main objective of commercial bank? The main objective of commercial bank is to accept deposits. This deposits becomes the biggest liability for the bank. So you are the bank, you are accepting deposit. Today or tomorrow you have to refund it. Accepting deposits, liability. And on this deposits, you have to pay interest. It becomes the biggest expense of your bank is interest on deposit. Deposits are accepted mainly in four forms. I'm using the word mainly. One is savings deposit. Savings deposit, also called as time deposits. Then fixed deposits. We call it as term deposits. Third, current deposit. Some people call it as call deposit. Some people call it as demand deposits. Last, recurring deposits, which we call it as RDs. Money received by your bank by accepting deposit. From that money, you will first keep a minimum balance with Reserve Bank of India. We call it as CRR. After that, you must have to keep some liquid asset with you, SLR. And then whatever is the cash available, your bank will use it in giving advances back to the public. This advance is given by your bank is biggest asset of your bank. And these assets, on that our bank has to give interest. Okay, that interest received by you is the biggest income for the bank, biggest revenue for the bank. What are advances? There are also four types, students. Number one, cash credit, overdraft, term loans. On these three, your bank will get interest. And the fourth one is bill discounting, that is bills purchased and discounted by your bank. In that, what you earn is nothing but interest, but the name given to that is discount. You all know discounting is nothing but interest fraction only. So your income, revenue is called as interest and discount. Throughout banking chapter, for advances, we will use the word assets. So whenever the word used is asset in a banking chapter, don't count it as premises and furniture and fixture and vehicles and whatnot. These are simple, okay, advances given by your bank on which your bank is going to get interest and discount. One more thing before I take one by one subtopics. Throughout banking company chapter, there are various percentages we'll be discussing. These percentages are as on today when I am making this video. By the time of your exam, the percentage may change. A question can come into your mind, sir, how will we come to know that? Answer is simple. That will be mentioned in the RTP issued by the Reserve Bank of or by ICI to us. So whatever guidelines Reserve Bank of India gives again and again, you're not supposed to worry about it. If ICI writes in RTP that this is applicable to you, yes, then it's applicable to you. Then that rate will change, if at all it has changed compared to what is taught to you. Okay, so we now start with one by one subtopics. I'll first take revenue recognition. Revenue means income. Recognition means recording. So revenue recognition means recording of income. For accounting purpose, income, interest and discount is revenue. You get on what? Definitely. We get it on assets. Okay. So on these assets, for this purpose of revenue recognition, assets are classified in two parts: performing assets and non-performing assets. Clear? So let us see. Revenue recognition, recording of income, of interest and discount on advances on assets, classified in two parts: performing assets and non-performing assets. Performing assets, accrual basis. What do you mean by accrual basis? You should record interest and discount received plus receivable outstanding. So interest and discount earned is to be taken care of. What do you mean by interest and discount earned? Interest and discount earned is nothing but received plus receivable. Non-performing assets, NPA, you should account for it on cash basis. What in the cash basis? Interest and discount received. Okay. So if it is interest and discount given on performing assets, you count both interest received as well as receivable. If it is on non-performing assets, only and only received, receivable cannot come. Cash system, a simple kind of table, and you can get the answer. Okay, very simple. Like question number 1 of our classwork is on this one, revenue recognition. The second important point is rebate on bills discounted. What do you mean by rebate on bills discounted, students? Rebate on bills discounted is unexpired discount, discount received in advance by your bank. Suppose your bank has discounted a bill on 1st January and bill is falling due on 1st May. So your bank on 1st January, while discounting the bill, will discount for a period of 4 months: January, February, March and April. 1st May is the due date. So your bank will deduct interest, what I mean to say, discount, for a period of 4 months. If you apply accrual concept, out of these 4 months, 1 month is falling due after accounting year 31st March. So 1 month is falling due in the next year. So out of 4 months discount received by your bank, 1 month is for the next year. That means your income of current year is only for 3 months. So from the beginning of the next year, 1st April, till the due date, 1st May, 1 month, discount received in advance, pre-received discount, unexpired discount is called as rebate on bills discounted. This rebate definitely is a pre-received income for you. If you remember 11th standard, common adjustment, income received in advance will have two effects. First, less from income, and second effect, balance sheet liability side. So same thing will be here, students. And if someone says, what is income of current year? I'll say 4,000 received minus 1,000 pre-received. So my income of current year is 3,000. The rebate on bills discounted at the end of the current year has to be deducted. And applying your 12th standard or CA foundation NPO subscription, if pre-received at the end of current year is subtracted pre-received of last year end, which is actually income of current year, should be added, right? So we go ahead with that calculation. Rebate on bills discounted. Question on rebate on bills discounted can be between 4 to 6 marks, requiring you to either pass journal entry or prepare ledger accounts. But before that, you should always prepare a working note to find out how much is our discount income of current year. How will you find discount income of current year? I just now explained you. Discount received plus pre-received discount of last year minus pre-received discount of current year. What I mean to say, discount received plus rebate on bills discounted at beginning of the year minus rebate on bills discounted at end of the year will give you discount income of the current year. See here, rebate on bills discounted. First, calculation of discount earned, say by Overseas Bank Limited, our class point only I took, for the year ended ... 31st March. Discount received on bills purchased and discounted. Add rebate on bills discounted at beginning, opening rebate, less rebate on bills discounted at end, closing rebate, is equal to discount earned, which is credited to P&L account. That's an income of the current year. What are journal entries for this? And you all know, friends, right from FIJC, journals are recorded chronologically in order of date. What do you mean by in order of date? My first entry should be for this rebate at beginning, and then other 3 entries like bills purchased and discounted, discount received in the current year. Then third entry will be rebate at end, and fourth entry will be discount earned, credited to P&L account. The entries are here. First entry for rebate at beginning, rebate on bills discounted account debit to discount on bills discounted. Narration is very simple. Second entry, if question is giving you information, that this is amount of bills purchased and discounted during the year. Bills purchased and discounted during the year, students. Okay. If that figure is available in the question, then only pass second entry, otherwise not. Second entry, bills purchased and discounted account debit to discount on bills discount. Discount is your income, nominal account, credit on incomes and gains. Your bank is purchasing bills of the clients, so for you they are assets, real account, debit what comes in, you are purchasing that. And the remaining amount your bank will credit to client's account. So to client account, in a rare case you pay cash, so cash account. Third, rebate at end, discount on bills discounted account debit to rebate on bills discounted. In the last entry, my rebate income is credited to profit and loss account, discount income. Entry, discount on bills discounted account debit to profit and loss account, being discount earned during the year, credited to P&L. I emphasize on this second entry again. Second entry has to be passed only if question gives you figure of bills purchased and discounted during the year. Like if you see our textbook, question number 2, 3 and 4, which are on this rebate on bills discounted. Look at second question. In second question, if you see, they've given you a trial balance. And in that trial balance, the word used is bills purchased and discounted. But what word you want is bills purchased and discounted during the year. Look at your trial balance. Do you have that? This is question 2. The word used is bills discounted and purchased. Nowhere the word used is bills purchased and discounted during the year. So if second question you pass journal entries, you can very well ignore entry number 2. Why? Because this trial balance figure 3 crore 15 lakh 47,000 is the amount of bills discounted remaining outstanding at the year end. What do you mean bills discounted remaining outstanding at the year end? They are closing bills purchased. They are not bills purchased for the whole year. In whole year, the bills purchased must have been quite more. They must have been discounted. They are already matured, and hence they are not appearing in the trial balance. So what is appearing in the trial balance is those bills which are not maturing in the current year, which will be maturing in the next year. So this 3 crore 15 lakh 47,000 is not, by any means not, bills purchased and discounted during the year. So in second sum, you cannot have second year entry. Same thing for third sum. You cannot have that entry. But in the fourth sum, if you see students, the word used is uncertain bank limited discounted bills of exchange of 4,000 crores charging interest rate 18% per annum during the year ended 31st March 17. So clearly the word given is during the year. So in question number 4, while passing journal entry, if they ask you journal entry, you should pass entry number 2, otherwise not. I hope the concept is clear. It reduces your time consumption in exams. That was the point of rebate on bills discounted, pre-received discount, discount received in advance, unexpired discount, different names. But you as a student have to use the word rebate on bills discounted. Second subpoint covered. Third one is, and of course students, I'll show it to you for each of this variety, which questions are there in our textbook. At the end of the revision session of banking company, I'll give you a list that for revenue recognition, which questions are there in the textbook, for rebate on bills discounted, which are there, etc., etc., etc. Okay, fine. Third one, RDD, provision for loss. Right from 11th standard, you have been in the habit of making this adjustment. RDD, rebate, provision for loss, provision for doubtful debts. Provision for loss is a word applicable basically to banking industry. If you remember 11th standard, RDD we always used to calculate on debtors. The question comes, sir, who are debtors of bank? Answer is simple. Debtors of bank are those people to whom our bank has given advances. Just now I told you 4 types of advances: cash, credit, overdraft, term loans, and bills purchased and discounted. So they are your debtors. At the year end, your bank has to provide for loss, RDD, on those debtors. For revenue recognition, losses are classified, assets were classified in 2 parts, performing asset and non-performing asset. For this particular point, provision for loss, assets are classified in 4 parts: standard assets, substandard assets, doubtful assets, and losses. Standard assets are those advances, those customer of your bank who are repaying principal and interest and both in time. Sometimes delay happens, but they are not defaulted people. Standard assets. Those who make default are called as non-performing assets, NPAs. In NPA, further three classification: substandard, doubtful, and last one, loss assets. If any of the asset has been defaulted for a period of less than 12 months, that is called as a substandard asset. If any of your advance which is substandard for more than 1 year, it remains substandard, but for more than 1 year, it becomes doubtful. And loss assets are those assets, those advances, which either your management or your auditor, whether internal auditor or statutory auditor, they think that no, is absolutely non-recoverable. We cannot be able to receive this money. They are called as loss assets. First, for the purpose of calculation of provision for loss, the guidelines of RBI suggest some different percentages. You have to remember those percentages, and as I told you at the beginning of this video, that these percentages are likely to change. The bestest source, reliable source is RTP issued by Institute of Chartered Accountants of India for your attempt. Just refer to the RTP. If there is any change, it will be mentioned there. Immediately apply that in your sum. So, for RDD, provision for loss, this is your table. Advances classified in 4 categories: standard assets, substandard assets, doubtful assets, loss assets. Standard assets, if they are advances to agriculture and small and medium enterprises, 0.25%. If it is advances to commercial real estate sector, 1%. And for others, it's 0.4, means 0.40%. For substandard assets, they are classified in 2 parts: secured portion and unsecured portion. Secured portion means the portion for which, suppose you have given a loan of 10 lakhs, and against that your bank has a security of 7 lakh. So secured portion is 7 lakh. On that, RDD 15%. Unsecured portion has 2 further classification. With escrow account, question will mention what is escrow. RDD 20%, normally those which are into infrastructure sector, etc. And others, they are unsecured but not escrow, 25%. Doubtful assets, those which remain substandard for more than 1 year. Secured and unsecured. If you see unsecured, 100%. Those which are secured, doubtful up to 1 year, 25%. More than 1 year, up to 3 years, 40%. And more than 3 years, 100%. And last one, loss assets, 100%. One more point to be noted by you people in this calculation part are 2 subpoints. If any of your loans and advances are guaranteed by ECGC or DICGC, that is Export Credit Guarantee Corporation of India, Deposits Interest Credit Guarantee Corporation of India, then that guarantee given by ECGC or DICGC should be deducted. But deducted from what? Deducted from unsecured portion. Why? Because for secured portion you have a security. So why your bank needs On secured portion, again guarantee of ECGC or DICGC. So guarantee of ECGC and DICGC is always related to unsecured portion. So they should be deducted from unsecured portion. And second, the security should be always valued at its realizable value, means at market value. So this was a part for calculation of provision for loss. First one, revenue recognition. Second, rebate on bills discounted. Third, we discussed was provision for loss. And students, at the end when I will be showing you the chart, you will see that maximum time in exams, ICA had asked questions on variety number 2, rebate on bills discounted, and variety number 3, provision for loss. So these two are hot cake, you can say. They are normally more than certainty. Always it's there in the question paper and you should be dealing with it. Okay, 3 points done. Let us go ahead. We take the next subtopic, capital adequacy ratio, also called as risk adjusted ratio. Some people call it as risk weighted asset ratio. Different names are there. It is guideline given by Basel Committee. And as per Basel Committee guideline, it says that it should be minimum 9% maintained by all commercial banks. So what are those 9% maintained by all commercial banks? Okay. See, capital adequacy ratio is also called as risk weighted asset ratio. As per Basel Committee report, every commercial bank must maintain minimum capital adequacy ratio of 9%. It is calculated as follows: capital fund divided by risk weighted asset fully multiplied by 100. For the purpose of calculating, see, there are two parameters. Numerator is capital fund and denominator is risk weighted asset. So we take the first numerator. How do we calculate capital fund? For the purpose of calculating capital fund, the total capital of the bank is divided in two categories, tier 1 and tier 2 capital. So category 1 and category 2, we can call it as tier 1 and tier 2. Category 1, tier 1 capital includes the following: equity share capital. Of course, it has to be the paid up part. So you can also call this word as paid up equity share capital. Plus perpetual means permanent, non-cumulative preferences, all reserves and surplus, excluding revaluation reserve. You know it very well from majority chapters which you have studied. Revaluation reserve is not counted as a part of main reserves and surpluses. It's always kept as a separate thing. Minus intangible assets, minus fictitious assets, minus accumulated loss, minus deferred tax asset, and minus equity investment in subsidiaries. All these are guidelines given by Basel Committee and we have to follow accordingly. That is tier 1. What is tier 2 capital? Category 2. It includes perpetual cumulative preference share capital plus undisclosed reserves, a typical reserve permitted to banking industries in India, plus revaluation reserve which was not counted in tier 1, is counted in tier 2. But when you count it in tier 2, it should be revaluation reserve discounted by 55%. Discounted means reduced by 55%. Risk weighted asset, we are now talking about denominator. Like you had weighted average profits. What used to happen? On the profits, we used to multiply with weight. Weights were 1, 2, 3, 4, 5, etc. Here, The weights are given in terms of percentage of risk attached to it, starting from 0% till 150%. I'm giving you the brief idea that what things are covered in 0%, what are covered in 150%, etc., etc. All assets of the bank, including off-balance sheet items. Off-balance sheet items are contingent liability, are assigned specific risk weight in specific percentage. They are as follows. First one, 0% risk. What comes under 0% risk? It means on which assets the risk assigned is 0%. In short, they are the least risky asset for the bank. No risk at all in that. Cash in hand, balance with RBI, loans and advances guaranteed by government or public sector. Your bank is given loan to someone, and on that loan, either government or a public sector has given a guarantee. Investment in government securities, advance income tax, advance against term deposit, fixed deposit. Suppose I have got 10 lakh rupees of fixed deposit with your bank. This fixed deposit of 10 lakh, I give as a security to you, and against that you are giving me a loan, an advance. So safest loan it is. Even if something happens to me, even if I don't repay that, you already have FDs, and that to your FDs only. Term deposit means fixed deposits. E&O, guaranteed by government and public sector. 20% risk. Balance with other banks. Loans and advances guaranteed by other banks. E&O, guaranteed by other banks. There is acceptance, endorsement and other obligations. Investment in bonds issued by other banks and claim on banks. All these are covered by 20%. 50% risk. Loans and advances guaranteed by ECGC and DICGC. 125% risk. Loans and advances to share brokers and credit card advances. 150% risk, the highest risk. Investment in venture capital funds and non-funded exposure to real estate. And last, residual category. Students, what do you mean by residual category? Something which cannot come in any of those above 5 categories has to fall in 0, this 100% category. 100% risk. All other assets not covered above. All other A, E and O not covered above. Educational loans and leased assets, etc. This is a residual category. So you first calculate tier 1 and tier 2, that will give you numerator, capital fund. Then you calculate denominator, like name of the asset, amount of asset multiplied by risk percentage will give you risk weighted asset. The total of risk weighted asset will be denominator multiplied by 100, and that should be minimum 9% as suggested by guidelines of Basel Committee. Normally capital adequacy ratio sums carries weightage between 8 to 10 marks. They are a bit lengthy sums. More calculations are there. You as a student will have to take care that each of these items you should be able to remember. That this has this percentage, this has this percentage. If you remember this perfect definition of tier 1, tier 2, etc., etc., definitely the chapter is there in your pocket. There is nothing to worry. Capital adequacy ratio, risk weighted asset ratio. Some people call it as risk adjusted asset ratio. Next, going ahead, is in accounting we call it as dummy accounting. Guarantees given by your bank to a third party on behalf of your client Suppose I am one of your customer means I am one of your account holder of your bank. I am importing a machine from US. Mr. X is exporter. I did all finalization things with him. Everything is ready, all documentation, perfect things. The machinery is ready to be shipped from US. And the US exporter, Mr. X, says me, look, Mr. Y, this is our first dealing. We are staying in two different countries. Before I release the possession of the machine, before I ship it into the container, I want a bank guarantee. Is justified. So I came to you. You are my bankers. I request you that, sir, kindly give a guarantee to Mr. X on my behalf. That yes, I will pay him money for machinery. Your bank will scrutinize my account with your bank, whether everything is proper or not, no penalty, no irregularity, no check bouncing, etc., etc. And your bank is satisfied and your bank issues a guarantee to Mr. X that Mr. X, you send the machine to Mr. Y, who is our client. If Mr. Y doesn't pay, we will pay you. This guarantee given by your bank to the third party is a contingent liability for your bank. Why do I say, students, contingent liability for the bank? Because that in contingent liability, in future, it may be payable, it may not be payable. Say on the due date, if I, your client, I pay to Mr. X, the bank don't have to pay it. But suppose on the payment date, I fail to pay him because of any reason, then your bank under the guarantee will be paying to that fellow Mr. X immediately. Of course, you will recover it from me. But at present on the due date, because I failed to pay, you must pay him. So that is what we call it as a contingent liability for your bank. Acceptance, endorsement, and other obligations, shortly called as A, E, and O. Acceptance, endorsement, and other obligations. Now, when it's A, E, and O, students, you all know it's a contingent liability, and contingent liability is always a footnote to balance sheet. What do you mean by footnote to balance sheet? Contingent liability cannot appear in books of accounts, students. But if you don't show it in books of account, how to maintain the record? And hence it is suggested, guided to the banks, that even if it's a contingent liability, even if it should not have any existence in books of account as per accounting norms, to record contingent liability A, E, and O, you prepare two dummy accounts in the books of the bank, and two dummy accounts in such a way that they both are just opposite to each other. They are A, E, and O asset account and A, E, and O liability account. Mind well, they are not official accounts, they are dummy accounts. Ultimately, the net effect of them is zero. A, E, and O asset, A, E, and O liability. What are journal entries to be passed for dummy records? And which one will be actually in main books? Of course, these are also in the main books itself. These are dummy. Does not have any impact on final books. But one or two transactions are such which will definitely affect final books. For example, if I dishonor, if I don't pay, then your bank will pay. For you, cash is going out, genuine entry. And that amount you will recover from me, you will debit to me. So all these are genuine entries, main book entries. So we see what entries we pass for A, E, and O, the dummy entries, the temporary entries, and also in the main books. Okay, here. acceptance, endorsement, and other obligations. Transactions, the dummy entry, and the main books. First one, opening balance. What do you mean by opening balance, students? Opening balance means those guarantees which were given by your bank last year, but they are maturing in the current year. So they will definitely appear in A, E, and O asset account, debit side, to balance brought down, and A, E, and O liability, credit side, as by balance brought down. Opening balance, opening debit balance, and opening credit balance. So look at opening balance, A, E, and O asset, debit side, A, E, and O liability, credit side. Second, guarantee is given during the year. Already opening balance was there, plus you are giving guarantee during current year. Entry for guarantees given during current year. Can I say because of guarantees given, your contingent liability goes up? If contingent liability goes up, A, E, and O asset should go up. A, E, and O liability should go up. What should be the entry? Entry is A, E, and O asset account debit to A, E, and O liability. Please don't misunderstand that assets are going up and liabilities are going up. No. It's contingent liability going up, but that is shown as the accounting aspect in terms of dummy accounting. Next, client pays the guarantee amount. When client pays the guarantee amount on the due date, I paid money to Mr. X. So your bank does not have to pay. Can I say if your bank does not have to pay, your contingent liability will come down? Contingent liability means may be paid, payable, may not be payable. Now it is already paid off. So it's no more a contingent liability. So contingent liability comes down. If contingent liability comes down, entry, liability coming down. Okay. So asset will be credited and liability will be debited. Entry, A, E, and O. Liability account debit to A, E, and O. Asset account. Next, on the due date, I failed to pay, and hence, under the guarantee, your bank has to pay. What does this mean? When your bank pays, still the contingent liability will come down. It is no more payable now. You already paid it. So when contingent liability comes down, again the same entry, A, E, and O liability account debit to A, E, and O asset account. But at the same time, a genuine entry is also passed. Your bank is paying money. For your bank, cash is going out. Credit what goes out to cash account. And what to debit is client. Why? Because you will recover it from the client. So entry, client account debit to cash account. Closing balance, opposite to opening balance. Asset opening balance was in debit, so closing will be in the credit. Liability opening was credit, so closing will be in debit. So it's A, E, and O asset account, credit side, and A, E, and O liability, debit side, like by balance carried down and to balance carried down. Purely a dummy entry. All entries in such a way that even if it's contingent liability, you show it in books. Let it be on the records, and that records will give effect. Only one entry, which goes to genuine entries, main books double entry, is when your bank pays third party on behalf of the client. That was a genuine entry. Question will ask you to prepare ledger accounts. Once you know the entries, making posting in ledger account is very simple. Weightage around 4 marks in exams. Like A, E, and O, there is one more accounting. That is also we call it as a dummy accounting. What is that dummy accounting? If you remember your CA foundation or your 11th standard accountancy, bills of exchange chapter, the drawer of the bill has 4 options: retaining bill, discounting bill, bill endorsed, and bill sent to bank for collection. Out of these 4, there are 2 where bank is involved. Which 2? Discounting of bill, and next is bill sent to bank for collection. Discounting of bill we had seen just now, rebate on bills discounted. Now we see bills for collection. What is bills for collection? Your bank's clients, account holders, are giving their bills receivable to your bank. They are not selling it to you, they are not discounting it to you, they are simply transferring possession to you, not the ownership. Dear bank, kindly keep this bill with you. On the due date, on my behalf, go to my drawee, present this bill to him, collect money from him, deduct your bank charges, and remaining amount kindly deposit to my account. But here your bank is doing agency services, friends. The services on behalf of account holder, and for that of course your bank will earn some commission. That is called as bills for collection. Those bills whose physical custody lies with your bank, what are they for your bank? Are they asset? Are they liability? Are they contingent liability, or they are contingent asset? And answer is nothing. They are nothing for you. It's not your ownership. Ownership remains with the client. So forget about asset or liability. It's not your debt also. It's not contingent liability. Payable may not be payable. And contingent asset is not a term at all. So previous one, what I taught you just now, acceptance, endorsement, and other obligation, that was a contingent liability. It was appearing as a footnote to balance sheet. This one, it's nothing. Neither asset nor liability, nor contingent asset nor contingent liability. Right, friends? So, how to show that? Again, guideline says that because it is nothing, it cannot come in official books of account. But please prepare 2 dummy accounts. Same, bills for collection asset and bills for collection liability. BFC asset and BFC liability. Let us see the accounting for bills for collection. Transaction, dummy entry, main books, opening balance as usual, asset, opening balance will come in the debit, and liability, the opening balance will come in the credit. So first one, opening balance, asset and liability. Bill received for collection during the year. Opening balance was what? Those bills received already by your bank previous year, which are maturing in the current year. Now during current year, you got more bills for collection. So your BFC balance will go up. When you to increase that, asset will go up, so debit it. Liability will go up, so credit it. Ultimately, net effect is 0. So entry, BFC asset account, debit to BFC liability account. On the due date, 2 things will happen. On the due date, your bank will go to drawee on my behalf, client's behalf. 2 outcomes are possible. Drawee honors the bill, means drawee pays money to your bank. And drawee dishonors. Drawee says, no, sorry, I don't have money. So when drawee pays money to you, what your bank will do? your bank will deduct your commission and deposit remaining amount in my account. But the day when you go with the bill to the drawee, when drawee pays you bill money, you have to give that bill back to the drawee. What does it mean? The number of bills lying with your bank will come down. BFC will come down. So BFC asset will come down. Asset coming down means credited. BFC liability come down. Liability coming down means debited. So what is the entry? For bills honored, BFC liability account debit to BFC asset account. Official entry, double entry. For your bank, money is coming in, cash is coming in. So cash account debit. 2, you get some money out of it. Suppose you got 1 lakh from the drawee. And out of that, you are deducting 2,000 your commission. Commission is your income for the bank. Income, nominal account, credit all incomes and gains. So entry, cash account debit. 2, commission, exchange and brokerage account. And 2, client account. Bills dishonored. If bills are dishonored, your bank goes to drawee. Drawee says, sorry, we can't pay. Your bank comes back empty-handed. Your bank will inform me, dear client, your dishonored bill is lying in the bank. Kindly take it away. Your drawee has failed to pay money. The client will come to your bank, takes away the bill. So that bill will be a documentary evidence in the hand of the client to go for legal proceeding against the drawee. So entry, again, number of bills with your bank comes down. At the time of honoring, what happened? The bill was given by you to drawee. For dishonoring, the bill is given by your bank to drawer. But in either case, number of bills comes down, coming down. So entry saying BFC liability account debit to BFC asset. Do means the same. What is actual entry? Official. Your bank will take commission from me for the services offered. It's your income. Credit all incomes and gains. To commission, exchange and brokerage. And debit, you will recover it from client. So entry, client account debit to commission, exchange and brokerage account. Closing balance. What is closing balance? Bills lying with your bank at the year end, but maturing in the next year. The due date is there in the next year. So in BFC asset account, opening balance was in debit, so closing will be in the credit. Liability opening was in credit, so closing will be in debit. Same thing here. So BFC asset, it comes on the credit side, and BFC liability, it comes on the debit side. Accounting for bills for collection. Something and highly similar to accounting for acceptance, endorsement and other obligations. Again, question weightage around 4 marks for you. Highly similar accounting they are. So capital adequacy ratio, acceptance, endorsement and other obligation. And the last one is bills for collection. The next one, what we see is CRR, cash reserve ratio. Is the minimum balance with every commercial bank must keep with RBI. Is always certain percentage of deposits. Deposit means it can be time liabilities, current liabilities. So whatever are total deposits which your bank is having, a certain percentage of that must be your CRR. That must be cash balance with RBI of your bank. The CRR percentage goes on changing. If they ask a question on CRR, if they mention the percentage, well and good. We don't have to think anything. If they ask a question on CRR with no percentage mentioned, then the latest prevailing percentage will be applicable, and that is what I told you. The percentage will be available in your RTP, revisionary test papers. And that is only and only for a specific question on CRR. On other questions like final account balance sheet sums, CRR adjustment is not a hidden adjustment. CRR, if given in the adjustment, then only effect has to be given, otherwise not. Certain percentage of deposits. So if you see a question on CRR, on the past paper it was asked, the following information is furnished by Alpha Bank Limited, rupees in lakhs. Margins held again LC, there is letter of credit, recurring account deposits, current account deposits. Recurring account means RD, current account, you all know it very well. Demand deposit, unclaimed deposits, gold deposits, demand liabilities, portion of saving bank deposit, and time liabilities, portion of saving bank deposit. All these are different names, but they all are deposits. Explain CRR, and you're required to calculate amount of cash reserve ratio as per directions of the Reserve Bank of India. So if you see that, cash reserve ratio, for smoothly meeting cash payment requirement, banks are required to maintain certain minimum ready cash balance at all times. This is called as cash reserve ratio. Of course, this has to be kept with RBI. Cash reserve can be maintained by way of either cash reserve with itself or as balance in a current account with the Reserve Bank of India, or by way of net balance in current account or in one or more of the aforesaid. Every scheduled commercial bank has to maintain cash reserve ratio as per direction of RBI. The current cash reserve ratio is 4%, but I repeat, always going to change. You have to see the RTP issued and what is the rate applicable to your attempt. Have they changed it or not? Of the net demand and time liabilities, we call it as shortly NDTL, net demand and time liabilities. The calculation, margin held against letter of credit, it's a demand liability, recurring account, time liability, current deposit is demand liability, demand deposit name itself indicates is a demand liability, unclaimed deposit is a demand liability, at present is unclaimed, but the account holder can come on any day to your branch saying that, sir, give me my deposit. Demand, on demand, you have to give it to him. Gold deposits, demand liabilities, portion of saving bank deposits, and time liabilities, portion of saving bank. The total of all deposit is 3157, and on this total of 3157, CRR required is 4%. So 4% of 3157. So your CRR requirement is 126.28. Got it? So all clear. Total of all deposits and applying specific percentage on that, that becomes CRR. This kind of question can carry weightage between 4 to 6 marks in your exam. Along with this kind of sums, twice ICI came out with a question giving you an example of the loans and advance given by your bank against which the borrower, the account holder, has given you some security. Of course, the security market value goes ups and down. So question was asked that at year end, 31st March, this loan given by your bank against this security, whether your loan is a secured loan or not. Answer that. And very simple answer it should be that what is there on 31st March? If on 31st March, if on the day of balance sheet, on 31st March, if you have the amount of loan plus amount of interest and compare it with market value of security on 31st March. If market value of security is greater than loan amount, your interest amount, that means your bank is quite safe. Even if that fellow runs away, you have a security of a higher amount. That loan will be called as fully secured. Suppose the value of security is less than loan plus interest, you can call it as partly secured. Suppose the loan plus interest amount comes to 10 lakhs and market value of security on 31st March is 12 lakhs. You can easily say, yes, it is fully secured. But against this 10 lakh, if market value of security is 7 lakhs, that means it is partly secured, secured up to 7 lakh, for remaining 3 lakh it is unsecured. That kind of question was asked. Let us see. It is found from the books that a loan of rupees 50 lakh was advanced on 30th September 14. Advancement. Your bank has given a loan at 14% per annum. Interest payable half yearly. But the loan was outstanding on 31st March 15 without any payment recorded in the meantime, either towards principal or towards interest. Means the borrower has not given you a single penny back in this 6 months from September to March. What does it mean? 50 lakh plus 14% per annum, 7 lakh per annum. But we are counting for 6 months up to 31st March. 3,50,000. So 50 lakh loan plus 350 outstanding interest. Amount due is 53,50,000. Let us see what is the security value on 31st March. Next, the security for the loan was 1 lakh fully paid shares of rupees 100 each. The market value was rupees 98 per share. As per stock exchange information on 30th September 14, we are not concerned with that. We want market value on year-end date on 31st March. Number of shares given as securities 1 lakh shares. Due to fluctuation, the price fell to 45 per share in January 15. I am not concerned. On 31st March 15, the price as per stock exchange rate was 85. Yes, I am concerned. 85 on 31st March. 1 lakh shares, 85 per share. The market value of security is 85 lakhs. What is the amount of loan? Plus interest, 50 lakh plus 350. So 53 lakh 50,000. Loan plus interest. Clearly, our bank has got a security of a higher amount. So, our loan in balance sheet of the bank is classified as good loan and fully secured loan. State how would you classify the loan as secured or unsecured in the balance sheet of the company. Company means balance sheet of the banking company. For classifying the loans as fully secured or otherwise, the value of security as on the last day of the year is considered. The value of security is rupees 85 lakhs, covering amount of loan and interest due comfortable, because that amount was 50 lakh loan plus 6 months interest at 14% per annum, 3 lakh 50,000, so total 53 lakh 50,000. Hence it is to be treated as good and fully secured. Clear everyone? That was question on loan classification. A related question was asked once by ICI on a cash credit account, overdraft you can say, giving 3-4 cases differently and requiring students to classify. The dear students, from this situation 1, 2, 3, 4, give answer whether this cash credit or overdraft is non-performing asset or not. Is it NPA or not? Is it a defaulter or not? So we must know what are the rules which makes a cash credit or an overdraft as NPA. These are the rules in front of you. The rule for making it NPA, a cash credit or an overdraft. First one, the outstanding balance remains continuously in excess of sanction limit or drawing power for a continuous period of 90 days prior to the balance sheet date. This is balance sheet date, not data. 90 days before balance sheet date, the outstanding amount is more than sanction limit or drawing power. If not, though the outstanding balance is less, means suppose condition number 1 is not fulfilled, then the sanction limit or drawing power, there have been no credit. That's what do you mean by there have been no credit? The borrower has not paid you a single naya paisa. See, when you give loan or overdraft or cash credit to me, you will debit my account. And when will you credit it? When you receive something from me as a repayment. So when line says that there is no credit, means what? The borrower has not repaid anything. There have been no credits, means no payment, no repayment at all, for a continuous period of more than 90 days prior to the date of balance sheet. Or credits. First one was no payment at all. And second one, suppose there is some payment. I have given you some repayment, some credit. Credit during the aforesaid period are not enough even to cover the interest debited during this period. In this period of 90 days, suppose interest debited is 40,000. Forget about the principal. Interest debited on overdraft or cash credit is 40,000 by a bank, and I repaid you only 10,000. Case 1 was no repayment at all, and if there is a repayment, the repayment is less than the amount already debited by your bank towards my account in the interest. Case C. Further, any amount due to bank under any credit facility is overdue if it is not paid on the due date fixed by the bank. So question was asked having 4 situations. State with reason whether the following cash credit account is an NPA or not. Okay. Yes, R. The word here is R, NPA or not. Okay. Case 1, 2, 3, 4. Sanction limit 50 lakh. I'm going through case 1. Drawing power 44 lakh. Amount outstanding continuously from 1st January to 31st March. January 31, February 28, March 31, 90 days is 40 lakhs. So amount outstanding 40 lakhs here. And this 40 lakhs is but natural less than the sanctioned limit So first condition for declaring that as NPA is not fulfilled. Go ahead. Total interest debited is 3,20,000. And how much is total credit? Total credit is 180. Here comes the NPA. Why? This condition is fulfilled. This condition applies. The credit in the aforesaid account are not enough to cover the interest debited during the same period. Means B2 makes it NPA. This is NPA. For your knowledge, it is condition B, second condition. Next one, situation 2. Case 2. Sanction limit 60 lakh, drawing power 56 lakh. Amount outstanding is 48 lakh. It is less. So first condition does not satisfy. Total interest debited 3,84,000, and look at that. No credit at all. No credit at all means also it is NPA. It was B1. In exams, you can write it in the form of a simple statement after writing those definitions. That since there is no amount credited in a period of 90 days, it is NPA. You can explain it in simple language of yours. And one thing is sure, once you write this condition perfectly in exam, if this kind of situation is asked, everything is self-evident. Okay, continue. Next, third situation, 55 lakh, 50 lakh, and yes, my goodness, 56 lakh. So amount outstanding is clearly more than sanction limit or drawing power. So that makes it NPA. That was the first one as A. In this was also this NPA, applicability condition A. Last one, situation 4, 45 lakh sanction limit, drawing power 42 lakhs. Amount outstanding continuously for a period of 90 days is 30 lakhs. No, it is less. Interest debited is 240 and total credit is 320, more than interest debited. Means no condition treating this account as NPA is satisfied. That means this is not NPA. What do you mean by not NPA? This is a performing asset. It cannot be classified as non-performing asset through any of the conditions mentioned below. I repeat, just write those conditions once in the solution and then write down 2-3 lines for each. That case 1, it is NPA because amount credit 1,80,000 is not even sufficient to cover interest debited 320. This kind of simple language you can write and answer is self-explanatory to the paper checker because he knows that you wrote all conditions, so you know all the conditions. The answer is there in your pocket. Classification of NPA. Okay. So first I started revenue recognition, rebate on bills discounted, provision for loss, capital adequacy ratio, acceptance, endorsement and other obligations, bills for collection, classification of NPA, classification of loan whether it is secured, unsecured or partly secured. And next one, what we discussed already was CRR sum. So 9 varieties, small subtopics in your eyes. We now move to full length ones. There is profit and loss and balance sheet. We take profit and loss discussion now. What is profit loss? You all know, friends. List of incomes and expenses. For a bank, incomes and expenses. Vertical format suggested by Banking Regulation Act 1949. Like in companies, you have notes to accounts. For the banks, the word is schedule forming part of profit and loss account and balance sheet. Schedule 13, 14, 15, 16, and one more called as provisions and contingencies will affect profit and loss account. First one, Schedule 13. What will come in Schedule 13? The biggest income for the bank, interest earned. Which interest earned? I can say interest on cash credit, interest on overdraft, interest on term loans, interest on balance with RBI, interest on balance with other banks. Right, students? Likewise, you receive interest on investment. But instead of using the word interest on investment, the word used there is income from investment. Why? That investment can yield you two types of income, interest as well as dividend income. Hence they use the word income from dividend. All these are interest incomes. One more, in the form of interest only, was discount income. We studied that for discount income, it is with two adjustments. One, the rebate at beginning to be added and rebate at end to be subtracted. All these figures will come here. These are all Schedule 13, major income of the bank. Schedule 14, other income. Name indicates. What do you mean by other incomes? Incomes other than main income, interest and discount. What are other income? The biggest one. Just now we have seen that word. Commission, exchange, and brokerage. You can have lockers rent if your bank is having safe deposit vault. Lockers rent. What are other incomes? Profit on sale or revaluation of fixed assets or investment. In a single line, I wrote 4 lines. Profit on sale of fixed assets, profit on sale of investment, profit on revaluation of fixed assets, and profit on revaluation of investment. If any of them is negative, loss, then it has to be subtracted. Loss on sale or revaluation of fixed assets. All these are other incomes, incomes which are other than main income, interest and discount. Schedule 13 and Schedule 14. Schedule 15 and 16 are for expenses, students. Schedule 15 is interest expended. Interest expended by your bank, definitely biggest income is expenses, interest on deposits. So Schedule 15. Interest on deposits. Next, interest on borrowings. Borrowings done by your bank. You borrow from Reserve Bank of India, you borrow from other banks, you borrow from financial institutions. So all these are your interest expenses that will come in Schedule 15. All expenses of the bank other than interest expense goes in Schedule 16. We call them as operating expenses. Salary to staff, bonus to staff, provident fund contribution of staff, salary to directors and management people, telephone bill, light bill, audit fees paid to chartered accountant, legal fees, printing and stationery, traveling expenses, what not. All expenses other than interest expense will go to Schedule 16. Operating expenses. Yeah, the format also suggests a new one, an extra expense list, which is called as provisions and contingencies. It's shortly called as P&C. Provisions and contingencies includes first, provision for loss, provision for doubtful debts. We've seen that big chart. Standard assets, substandard assets, doubtful assets, loss assets, etc. Other provisions. There may be some other provision given in the question. Like in one of our question of J.K. Shah book, if you remember, you had that point of provision for revaluation loss, is loss on revaluation of investment. This particular sum. Okay, this point. Of course, I'll be discussing that in detail, both the sums of P&L. Okay, so that you can get recollection of what this question stands for, 9 and 10. Next, going ahead, and last one is provision for taxation. We'll call it as P&C. So income, schedule 13 and 14. Expenses, schedule 15, 16, and provisions and contingencies. The main format, the face of P&L is like this, which includes a hidden adjustment for you people, profit and loss, income, interest earned, schedule 13, other income, schedule 14. So total. Interest expended, schedule 15, operating expenses, schedule 16, and provisions and contingencies. These are total expense. Total income minus total expense will give you profit or loss for the year. In this profit or loss for the year, we add or subtract, depending, profit or loss brought forward is last year's closing balance, which is current year's opening balance. The total comes here. From this total profit, we make appropriation. The hidden adjustment is at least 20% of this figure, which is this figure, this net profit of current year, should be transferred to a reserve called as statutory reserve. 20%, at least, I'm using the word. It can be 25, it can be 30. If question says transfer 25%, well and good. If question is silent, by default, you have to transfer 20% of net profit. This figure, students. The error done by many students in exams is they calculate 20% of this. No, this is wrong. It cannot be 20% of this. It has to be 20% of net profit of current year. Always transfer to statutory reserve. Transfer to other reserves. Now, transfer to government or proposed dividend. And lastly, from this total, so this was a total. This total is A. For example, I am saying this. Appropriation, B, appropriation C, appropriation D. Now, how will you get surplus? Surplus is nothing but total of profit A minus all appropriation minus B minus C minus D. Closing balance of profit and loss, which is brought forward, carried forward to next year. And this profit, closing balance of profit from P&L, goes to balance sheet under schedule 2, reserves and surplus. Last total, definitely the total has to be same total what we got here. A has to come here also. Got it, everyone? This was a basic structure of P&L, vertical format. Schedule 13, interest earned, 14, other incomes, 15, interest expanded, 16, operating expenses, and last, P&C, provisions and contingencies. A brief idea about what your profit and loss account will consist of. We just like to see how the thing goes for a sum of P&L. Your first job will be to classify the trial balance, whether it goes to Schedule 13, 14, 15, 16 or P&C. Like for example, the question is there in front of you. From the following information, prepare profit and loss account of Modern Bank Limited on 31st March 11. So given you both figures, previous year and current year. Interest and discount is our income, 13. Income from investment is also our income, 13. Interest on balance with RBI, 13. Commission, exchange and brokerage will go to Schedule 14, other incomes. Profit on sale of investment, also 14. Interest on deposit, expenditure, 15. Interest on RBI borrowing, also 15. Payment to and provision for employees, 16. Rent, taxes and lighting, printing and stationery, advertisement and publicity, all this are a list of operating expenses for you. Depreciation, director's fees, audit fees, law charges, postage and telegram, insurance, repairs and maintenance, all 16. First adjustment is crucial and applying. Brain required that. Be careful. It says in the first adjustment, following items are already adjusted with interest and discount credit. First of all, make it very clear what do you mean by following items are already adjusted. They are not saying already added, already adjusted. With what? Interest and discount credit. Interest and discount credit is income, which is a trial balance first figure in this. So these 4 items are already adjusted with it. What do you mean by adjusted with it? If they were worth adding, they are added. If they were worth deducting, they are deducted. Simple logic. This is income. If any of these 4 is expense, it must have been deducted. If any of this is income, it must have been added. So you as a student have to think that these 4 which are adjusted with interest and discount is item of Schedule 13. Were they items of 13 that you adjusted there? If yes, well and good. If it is item of Schedule 13 and adjusted in Schedule 13, no harm. But if it was item of Schedule 14, 15, 16 or provisions and contingencies and you adjusted with 13, that's an error. That has to be rectified. Come on, see. What is the first one? Provision for taxation. No, not at all. Provision for taxation is item of P&C. It's an expense. Your accountant adjusted that with interest and discount. Schedule 13. That is income. This is expense. He must have deducted it. Rectify. If it is wrongly deducted, first effect, add to 13. So add back to interest and discount. And second effect, give correct effect. It's an item of provisions and contingencies. Next, provision for doubtful debt. Same. It's an item of P&C. And you wrongly deducted it. Why deducted? It's an expense. Schedule 13 is income. So you must have subtracted. So same way. 2 effects. First, the one which is wrongly deducted should be added back. Add 13. Second effect, the proper place is provisions and contingencies. Loss on sale of investment. No, it's not an item of 13. It's an item of Schedule 14. It's loss. You must have deducted it. So first effect again. Add back to 13. Second effect, less from 14. Profit on sale of investment will be adjusted with loss on sale of investment. Here is profit on sale of investment. This interest and discount will have three adjustments as we decided. All three added back to it. What is the last one? The last one is rebate on bills discounted. Yes, that's an item of 30. Rebate on bills discounted given in the adjustment has to be closing rebate, and that has to be deducted from schedule 13 and adjusted with 13 only. That is not an error, and when it's not an error, no need to rectify. No need to rectify means no effect of that in the solution. I hope you are clear. Appropriation, 25% of profit is transferred to statutory reserve. Always hidden adjustment minimum 20. They are transferring 25%. Well and good. Another 5% of profit transferred to revenue. So this is the way a P&L sum has to be approached by you. First classify it perfectly, schedule wise, make the format, and then job is just like filling the blanks. Take the figure, put it in appropriate schedule, write it, total it, answer has to. Clear about it? That was a bird eye view of the first question only and only on P&L account, schedule 13, 14, 15, 16 and provisions and contingencies. We take one more example on P&L as a discussion part from the adjustments point of view. This is question number 10 of our JKSC textbook. Trial balance as usual has to be classified, nothing new in that. The first adjustment says interest on NPA is as follows. You all know revenue recognition. Interest on NPA has to be counted and recognized on system of cash, means received. Now, if you see here, the adjustment is telling you that interest on NPA amount earned is given as well as amount collected is given, right? So, cash credit, overdraft and term loans. Now, interest earned, because when you prepare a trial balance, it has to be on mercantile system, accrual system. So, these three figures must have gone into trial balance for this concerned NPAs. But actually, which figure should have gone is these three figures. So, what should do? The one which is excessively recorded in the trial balance should be deducted from it. That means interest on cash credit 820 is earned, collected is 400, the one which is not collected, how much? 420, not collected means due still. 420, 450 minus 100 is 350, 750 minus 250 is 500. So, this free amount not collected on NPA still recorded as income in the trial balance, first three items of the trial balance, that should be deducted by you. Simple adjustment. The second adjustment is for classification of advances. That is simple calculation of provision for loss, and that is not difficult at all. This one is important. Now, students, you know what happens is that investments held by any organization has to be classified in two parts, short term and long term. There is non-current investments and current investments, okay? Long term and short term. For a bank can maximum invest 25% of its total investment in long term. So, long term can be max 25%, whereas short term, when this is max 25%, short term has to be minimum 75%. For banking companies, the long term investments are called as held to maturity investments. Short term are further classified in two parts. One is held for trading and second is available for sale investments. If you read our adjustment, friends, the adjustment says you the total investments are 2750, precisely it is in thousands. So, total investment is 27,50,000 rupees. Now, out of 27,50,000, it says bank should not keep more than 25% investments. Okay, it should not keep more than 25% of the investment as held to maturity investment. So, out of 2750, 25%, of course, the figure is cost. So, this also has to be cost. So, 25% of that, this cost has to be 687.50. And all of you know, long-term investments are always valued at cost. Short-term investments are always valued at what, students? Lower of cost or market price. So, that part is okay, 687.50 is okay, fine. This is 2750 because the question is giving you figures in thousands. I am also writing in thousands. Next line says, the market value of its held for trading 75% investment is 2052.50 thousands on 31st March 17, that is at the year end. Come on, let us calculate. 75% is held for trading. If you calculate 75% of total cost, it comes to 2062.50. Whereas the question is saying you that market price is 2052.50. It should be valued at whichever is less. What is less? Definitely 2052.50. So, from 2062.50 making it 2052.50, so there is a reduction in the value. It is loss due to revaluation. And what we should do is we should create a provision for that. So, my answer here will be provision for loss on revaluation of investments 10, and this will go to PNC. What is PNC? Provisions and contingencies discussed to you in the previous question. 3 provisions are there: provision for doubtful debts, other provisions, provision for taxation. This one will be the second one, other provisions. You will write provision for loss on revaluation of investments. In the last adjustment there, if you see, is provide for tax at 40%. Now, how do you calculate provision for taxation? Simple, all income minus all expense other than taxation will give you net profit before tax, and on that you calculate 40%. So, how do you calculate provision for taxation? Is incomes, Schedule 13, interest earned, Schedule 14, other income. So, that will give you total of incomes. Then Schedule 15, interest expended, subtracted. Then Schedule 16, operating expenses, that is also to be subtracted. And then all other provisions other than provision for taxation. So, I will subtract provision for doubtful debts, which you get from second adjustment in this sum, and one more, just now we calculated other provision, that was that provision for loss on revaluation. This resulting figure is your net profit before tax. So this is called as net profit before tax, and on this figure, when you calculate 40%, that will give you the amount of provision for taxation. Everyone, okay? So this is the way you calculate provision for taxation. Question number 9 of our textbook, 10 of our textbook, both exclusively on profit and loss account. That is what we discussed. We now try to see the bank final account, that is a balance sheet part. P&L we have schedule 13, 14, 15 and 16. Balance sheet will have 12 schedules, schedule 1 to schedule 12. Schedule 1 to schedule 5 will be on the liabilities, 6 to 11 will be assets, and 12 will be contingent liabilities. If you see, the vertical format is there in front of you on the screen. Schedule 1 is capital, that is share capital. 2, reserves and surplus. 3, deposits. 4, borrowings. And 5, other liabilities and provisions. Schedule 6, cash and balance with RBI. 7 is balance with banks and money at call and short notice. 8 is investments. 9 is advances. 10 is fixed assets. 11, other assets. And as a footnote, 12, contingent liability, and at the end, after contingent liability, one more disclosure is bills for collection, which is neither an asset nor a liability nor a contingent asset nor a contingent liability. What can come, as you know, note 1, capital will be highly similar to what we used to write in a company account, like you start with authorized capital. The amount of authorized capital, if it is there, you write or put a question mark and then 2 underlines always, because that is not to be considered in the total. Then issued, subscribed and paid up capital, this many shares of this much. Simple, nothing difficult. No disclosures like company accounts here. Note 2, reserves and surplus. The biggest reserve will be statutory reserve. That will always be in the inner column, because there will always be an addition to it in the current year. Minimum 20% of net profit transferred to statutory reserve. Other reserves can be like general reserve and capital reserve and so on. And lastly, it will end with the surplus. What is surplus? Surplus is balance of profit and loss account. The P&L account last line, when we used to write balance carried over to balance sheet, this one. We'll go to note 2. Note 3 is deposits. Deposits will include main 4 deposits: savings, current, fixed deposit and recurring deposits. 4 is borrowings. Our bank has borrowed from Reserve Bank of India, borrowing from other banks, borrowing from what you call it as financial institutions. Schedule 5 is other liabilities and provisions. You have a liability called as inter-branch adjustment. You also call it as inter-office adjustment or branch office adjustment, when one branch has taken money from another branch. So for our branch it is payable, it will be schedule 5. For other branch it is receivable, schedule 11. Provisions included here are provision for taxation, provision for doubtful debts, other provisions and proposed dividend. So all this will come in schedule 5. Schedule 6, cash means cash in hand, and second, balance with RBI, which is minimum CRR. 7 is balance with other banks and money at call and short notice. Balance with other bank means our bank has kept money with others. Money at call and short notice is highly liquid investments or highly liquid assets. 8, investments. Bank can do investment in shares, debentures, bonds, government securities, investment in gold and investment in immovable properties. 9 is advances. Biggest 4 advances of a bank:
cash credit, overdraft, term loans and bills purchased and discounted. Not to forget one thing, these advances, after writing them according to type of advance like cash credit, overdraft, term loans and bills purchased, you also have to classify advances security wise. What do you mean by security wise? It says secured by tangible assets, then covered by bank and government guarantee, and third one unsecured. So advances has to be classified in two different ways. First you will write all advances like cash credit, overdraft, term loans and bills purchased and discounted, and then classifying them as per their security. Schedule 10 is fixed assets, simple one. It has to be shown as cost, accumulated depreciation and WDV. 11 is other assets. Example of other assets are inter-branch adjustment having a debit balance. The branch which has given money to another branch, it has to receive. Interest accrued on advances, interest accrued on investments. One more can come here, and that is non-banking assets. What do you mean by non-banking assets? Those securities which bank has seized from the defaulters for non-payment. So bank can be owner of ornaments, bank can be owner of a flat, bank can be owner of a vehicle. All these are covered by non-banking assets. Schedule 12, contingent liabilities. Same like company account, claim against the bank not acknowledged as debt, arrears of cumulative preference, dividend. The biggest one we already discussed, acceptance, endorsement and other obligation. Guarantee given by bank on behalf of the account holder to a third party. And then from schedule 13 onwards. So schedule 1 to 12 balance sheets, 13, 16. There is 13, 14, 15, 16 and PNC will be PNL. I am showing you a ready-made list of most common adjustments what can be asked. We now reach the balance sheet items. The last one to conclude out with banking company final account students. And I am showing you a list of common adjustments what you can have in a chapter of bank final account full length sum where they ask you balance sheet, P&L both. So these are the most common adjustments, and what you should remember is that their effects schedule wise. Now everyone knows right from 11th standard depreciation has two effects, less from asset and P&L debit. But as far as banking company is concerned, which schedule it will affect. So those things we are going to see. Okay, say first one, depreciation. The first effect is schedule 10, that is fixed assets, and then second effect schedule 16, operating expenses. Rebate on bills discounted. Of course, when you say about adjustment, it has to be rebate at end of the year. Then first effect is schedule 5, it is other liabilities and provisions, and schedule 13, less from discount income. Provision for doubtful debts, same, provisions and contingencies, and second effect schedule 5. Then provision for doubtful debts and provision for taxation, both are provisions. So first effect remains same, PNC, provisions and contingencies, and second effect schedule 5. Going ahead, amount transferred to statutory reserve. You all know it's always a hidden adjustment. Minimum 20% of the net profit of the current year must be transferred to statutory reserve. Two effects, first appropriation and second effect schedule 2, that is reserves and surplus. Amount transferred to other reserves, so effects remain same, first P&L appropriation and second added to that other reserve in reserves and surplus. Proposed dividend is an appropriation. So first effect, P&L appropriation. Second effect, it's a kind of liability, Schedule 5, other liabilities and provisions. Interest accrued on deposits. See, our bank has to pay interest on deposits. It's an expenditure for us, right? And that is outstanding. So it's like an outstanding expense. First effect, interest on deposit is our expense, Schedule 15. So first effect, adding in Schedule 15, and second effect, it's a liability, Schedule 5. Interest accrued on borrowings, interest outstanding on borrowings. First effect, Schedule 15. Second effect, Schedule 5. Schedule 5 means payable, other liabilities. Interest accrued on advances. So this is interest receivable. Interest on advance is an income for our bank. It is accrued, outstanding, receivable. First effect, it's our income, goes to Schedule 13. And second, because it is receivable, it's an asset for us, Schedule 11. Next, interest accrued on investments. What do you mean by interest accrued on investments? Interest receivable. And when you talk about interest receivable, friends, investment interest is our income. And when you talk about interest receivable, means it is receivable income. It's an asset. So first effect, Schedule 13, income, and second effect, it's an asset, Schedule 11. Okay. One and the most important adjustment, which is striking ICA papers many a time, that overdraft wrongly adjusted with current account. I'll just explain you in short as to what this is standing for. Students, for a banking company chapter, there are some items which can have a trial balance debit as well as credit balance. Just by looking at the particulars, you cannot blindly identify the schedule number. Example, I am talking to you. Interest. For a bank, interest can be debit, interest can be credit also. Debit interest is interest expended, Schedule 15. Credit interest is interest income, Schedule 13. Likewise, you can have rent also. Rent debit means rent paid, operating expenses, 16. Rent credit means locker's rent, other income, 13. Going ahead, friends, loans. Loans debit means our bank has given loan, one of the main function of our bank. That is Schedule 9, advances. Loan credit means we have taken loan. Borrowings, most common. You study in economics, lender of last resort. Our bank will borrow from RBI. That will be Schedule 4. And somewhere your BRS concept, current accounts. Now, current account of a bank is a deposit. Normally should have a credit balance, Schedule 3. But there are chances of current account going into negative, a debit balance, and all of you know BRS, debit balance as per passbook, overdraft. So if it is debit, overdraft, Schedule 9. Now the point I am touching in the adjustment is, suppose your bank has got 100 current accounts. Out of 100 current accounts, 97 has a credit balance and 3 has a debit balance. For simplicity, I am assuming all having 1000 balances. So 97,000 and 3000. So what should happen? This 3000 is overdraft, should go to Schedule 9. 97,000 is a favorable balance deposit for us, Schedule 3. But your accountant, what he did by mistake, he didn't wrote this 3000, nor he wrote this 97,000, he gave a net effect of 94,000 here. Means overdraft debit balance has been adjusted with positive balance of current accounts. Now arithmetically it is correct. Trial balance will tally, balance sheet will also tally. But principally it is wrong. So whenever overdrafts are wrongly adjusted to current account, how to rectify? Simple. If they were wrongly deducted from current account, you will add it back to current account. So 94,000 plus 3,000. So first effect, adding in current account means add in schedule 3. Second effect, its correct effect we should give. We should be adding it to overdraft. And overdrafts are schedule 9. So first effect, add in schedule 3 current accounts, and second effect, add in schedule 9 overdrafts. So all this was a complete list of our 12 adjustments. And friends, once you remember this all 12 adjustments, definitely more than that is not possible. It's an overall view, you can say a combined view. All possible adjustments of banking company are there in front of you. Just remember them, start giving effect directly. In exams, we will not have time to think and then give effect. That much luxury you can't enjoy in exams, students. Got it? For your easy reference, I've given you this particular thing. Means for each topic, which questions are covered by us in our banking topic, like revenue recognition, question 1 and question 36. Rebate on bills discounted. You can see the question numbers. Same thing for provision for doubtful debts, A, E, and O. Bills for collection, capital adequacy ratio, questions on profit and loss, questions on balance sheet, loan classification, NPA sum, those 4 cases, and CRR sum. So this in a nutshell will help you in making it understand that yes, we have to do this much things in banking company final account. Not to forget a short question, minimum 6 marks, it can range up to 16 marks. Also reminding you all percentages, what we have taught you are subject to change. Before your exams, you have to refer to revisionary test papers issued by ICI, which will mention you the latest rates which are applicable to your attempt. So please don't forget that. Don't take anything for granted. Chapter becomes very easy when you practice it logically. Do remember them. All summarize important points I already discussed with you. Okay, thank you very much.